G'day expats and welcome to another episode of Expat Chat, episode 122 today. And today we're doing more Q&A from our Australian Expat Financial Forum Facebook group. So thank you to everyone who's been putting up lots of questions in there. Great questions. I think the audience will love to hear them. Join with me today is my mate and colleague in the Australia, Mr. James Ridley, who's the Managing Director for Atlas in the APAC region. G'day, James.
G'day, Brett, and yes, mate, that Facebook group, it's growing every week. It's so good to see. I guess it's a very collaborative environment in there, but just love seeing someone that's in, say, Saudi Arabia or in Italy or in Canada throw out a question, and everyone else is obviously giving them their own feedback, even from sending stuff back home when you're repatriating back to Australia. It's great. What companies they used, all those little tidbits, which I think everyone's finding very, very insightful and just valuable. Often someone in that group's already been through it, so they're happy to share their experience and I guess how they went about it. And for those that are joining us on the podcast today and tuning in, YouTube to my left, Brett's I think left as well.
Yeah, same.
Got Brett Evans, the Managing Director of the EMEA region, Europe, Middle East and Africa region. How's the sandpit today, Brett?
Mate, it's obviously a bit interesting at the moment, watching the world events occurring on our sort of doorstep.
Ooh.
But
Oh, yeah.
nothing's really changing on this side anyway. I mean, I think the UAE is sort of the Switzerland of the Middle East. Beirut used to be called that. Hopefully it's not the kiss of death, but it's such a melting pot of so many different cultures and nationalities that everyone's sort of the country's sort of bipartisan in every sort of way. Everyone's sort of we've got Iranians and Israelis here. We've got Palestinians here. We've got Lebanese here. So it's funny how they all live here together and get on with it. Surprise, surprise. People can actually get on together from different cultures. But mate, let's get on with the show. All the information we're going to talk about today, especially today, should be considered as general advice, informational, educational, but not personal advice. If you do need to get personal advice, please speak to a specialist like Atlas. So, mate, let's get the good folks on the show today some informative information and let's get into these questions.
Sounds good, mate. So obviously pulling these from our lovely Facebook group, we've got the first question here that's been given to us by Neil. It looks like Neil is actually based over in the Middle East. He's in Abu Dhabi by the looks of it.
Yep.
Great question here, Neil.
I should be down there today.
So, yeah, you are. That's it, mate. You're on the road, surely. So, hi, is it possible to open a trading account in Australia to invest in Australian ETF or index funds while being a non-tax resident and living overseas? I'm currently based in Abu Dhabi and I'm an Australian citizen, but currently not a tax resident of Australia. I've tried to open an account, but don't have a TIN number as Abu Dhabi, or I guess the UAE, don't issue them. And can you make any recommendations on brokerage that allows you to invest as a non-tax resident in Australia share market if possible? Thanks in advance, Neil. It's a bit of a two-parter. I might talk about what a TIN is, and then I'll let you talk about brokerage and the issues that you constantly face. TIN stands for Tax Identification Number. In Australia, our TIN is our tax file number, TFN. When you're in the Middle East, because they, I guess, don't really have well, you don't have any individual tax. They have company tax and VAT. That's coming in. Probably personal tax at some point, maybe. But TIN often aren't issued when you are in the UAE. You usually are issued with Visa cards and those sort of things. But there is a selection under I guess, the relevant forms that you can state that the country doesn't actually issue a TIN.
Option B.
And that's right. Yeah, we don't have a tax treaty either with the UAE, obviously. So you won't be issued a TIN. Option B. C is another option as well, but it won't be relevant here. And then kicking over to you, Brett, about brokerage platforms and trying to get on them when you're a non-tax resident.
Yeah, so just on that TIN also, it doesn't relate just to brokerage, it relates to bank accounts as well too. So quite often we see a lot in the WhatsApp and the Facebook groups in the region about people asking for TINs. The UAE doesn't issue TINs, Saudi doesn't issue TINs. So option B is the best option for you to select. On the brokerage side, this is a complicated side, and the reason being is it's not actually a legislative reason, it's a platform-to-platform reason. So what I mean by that is there's no problems at all with you investing into Australian ETFs and shares. We do it all the time for clients. We've got close to 300 million of clients' funds that we help get invested into the Australian market. What it comes down to is the particular platform and the compliance regime that goes with that. So we have this rule called the Common Reporting Standard, 150 territories and countries, all sharing data. And what that means is the legislative requirement for that data to be shared. What it means for the ComSecs and the NABs and the CMCs and the ANZs of the world, Sharesies, there's quite a few actually that
there are.
fall on the same line. They don't want to have the headache of having to deal with non-residents. So pure and simple, they just say, if you're not in the country, we don't want to talk to you. What that means for expats is it's a little bit more difficult. So in order to not get around it, because you're not getting around things, in order to do an account in a compliant fashion, you need an advisor attached to that account. And the reason being is because if you call up ComSec, they don't know you're from a bar of soap. They don't know whether you're Mohammed or Fatima sitting in Kabul laundering money for the Taliban. Whereas when you've got an advisor attached to an account, that advisor's gone through what we call KYC, know your client rules, they've confirmed source of wealth, proof of wealth, you're legitimate, you're not dodgy, and able to go down that route. So whilst people will use discount brokerages to save money, and yes, it does cost more to have an advisor attached to an account, what it means is the account will be set up in a compliant fashion, and if it's done in a compliant fashion, you won't have to lodge tax returns. And the reason being is, as James pointed out before, depending on the country you're in, whether it has a DTA or not, a double taxation agreement or not, what it means is non-resident withholding tax may be withheld from your dividend payments. So it's either 15% if you're in a country that has a DTA or, and a lot of people don't know this, or has an information sharing agreement like the UAE. So UAE is only 15%, even though it doesn't have a DTA, or 30% for countries that don't have a DTA or don't have an information sharing agreement with Australia. So what a lot of folks try and do, they do the Texas two-step. They go, I'm going to go ComSec and I'll give my parents' address. As far as ComSec is concerned, guess what? They think you're an Australian. They think you're an Australian tax resident, and therefore they will not withhold any non-resident withholding tax. Folks come to us 2 or 3 years into the piece when they've sort of stumbled upon this problem, and then suddenly they're spending sometimes thousands doing tax returns, catching up on all of these returns they should have lodged because they didn't have the non-resident withholding tax being deducted. So the whole agenda of using ComSec was to save money. In actual fact, they've probably spent more money than they pay an advisor to be on that account and be providing guidance as well as obviously in a compliant sort of way. So unfortunately, for a lot of folks out there, the discount platforms in Australia aren't the solution. And a lot of folks run to IBKR, interactive brokers. Sometimes that's like jumping from the frying pan to the fire. And the reason being is if you're in the UAE, for example, and you set up a compliant account with Australia, you'll have 15% non-resident withholding tax deducted from unfranked dividends. If you go to IBKR, you'll have 30% non-resident withholding tax deducted from dividends. So now suddenly your tax rate doubles. And guess what? If your balance is greater than $60,000 and something happens to you, the IRS will take 40% as a estate planning tax. So just be careful when you are trying to find a solution from a cost point of view, because you could actually be making that problem a lot larger because you've made the wrong selection.
Yeah, trying to obviously fast track things and just cut, corner cutting, to be honest. I see it all the time. Good question there. Karen, a great question here by Karen. I'd like to know, when I get to pension age, what should I do as I worked in Australia up to 28, now 54, working holiday for 2 years, student visa for a few, then married, just got citizenship as separated, planning to retire here as my children are here. Don't know, to get pension age.
Where's here?
What should I do?
Is the question.
Yeah, I know.
Yeah. I think she's overseas, and unfortunately, the bad news for Karen is she won't get anything. And the reason being is I think she's referring to an Australian age pension, the government pension, not a super fund.
Yeah.
And there's the 35th rule. They go through and look at how many years in Australia you worked out of the 35 working years for eligibility. Even if Karen had worked in Australia for, let's say, 30 of the 35 years, depending on the country she's resident in, and depending on whether that country has a social security agreement with Australia, could she apply for that pension overseas? So what that means is if you're in Italy, for example, or China, surprisingly, sorry, not China. China is the other example, which doesn't have a social security agreement. If you're in Italy, you can actually apply for the 2-year waiting period and serve that 2-year waiting period in Italy. For a lot of other countries that don't have social security agreements, France is another one, you actually have to go back to Australia, apply for it, wait the 2 years, then you can leave. And even when you leave, they will scale the pension back as a non-resident. Yeah.
Yeah, you don't get the supplements. But further to that, remember, it is means tested. So depending on Karen's assets worldwide, that'll actually determine whether you're eligible for any of the, I suppose, old age pension from Centrelink. So that's a good question. I need probably a bit more context there where you're based at the moment. But yeah, still ways you can get it, but I just would say it's unlikely. I'd say you'd have to probably return to Australia and go through the appropriate testing and speak to Social Security so as well.
Exactly.
Good question. Next one, Michael. Great question here. Planning on returning to Australia in the next 3 to 5 years. I'm 48, so lots of working life left. Been in the UK for 18 years, so accumulated some assets. I've got a few queries about going back to Australia from the UK. What do I do with my share ISA? So that's a type of tax incentivized savings account over in the UK. Lots of clients have them. Number 2, I have a UK final salary pension. How does the Australian government treat this when I come to take it, especially with the 25% lump sum? Great question. Number 3, I have extra cash and thinking about adding it to a private SIP, or would depositing it into my Australian super be a better action given my plans to retire there? And last but not least, when is it best financially to sell my UK home? Oh, Michael, all great questions. God, we could talk about that for hours, couldn't we? Yep. It is juicy. This might occupy probably the rest of today's Q&A, to be honest. But that's right. Let's jump into it. A few queries about going back to Australia from the UK. Let's talk about the ISA. What do I do with my share ISA? ISAs are great. They're a tax incentivized vehicle. There are caps in terms of how much you can put in each year over in the UK. I can't remember the exact figure. I feel like it's £20,000 maybe.
20 or £25,000, I think it is, yeah.
That's right. That's right. So, but you can continue using them, and then you can then pull the funds out, withdraw the funds. You're putting it with after tax, it grows tax-free, then you can pull it out, also tax-free. What do I do with my share ISA? Well, the first thing that jumps out at me, you've said you are planning on returning to Australia in the next 3 to 5 years. I guess if it is invested in shares and you're coming back to the Australia and you still own that account once you resume being a tax resident, the ATO doesn't really see it as some sort of tax-deferred, tax-free account. It will look at it, see you've got investments in it. Deemed acquisition kicks in when you arrive. Relevant taxes would apply on capital gains, dividends, those sort of things. So it depends. If you're just a UK tax resident now, it might be more important to lean on, I guess, the tax concessions that you get from the UK and whether it's worthwhile maybe potentially drawing it before you actually resume being an Australian tax resident and stop being a UK tax resident. I wonder if he's also gone down the pathway of residency over there, permanent residency, non-dom, dom, all those sort of things. What are your thoughts, Brett?
And I think, and it sort of covers all 4 points.
Yep.
Folks can tie themselves in knots when they're trying to design a financial strategy as an expert.
Yeah.
The 40,000 foot strategy should be you want to accumulate assets in the country and tend to return to or retire to. The reason for that is there's 4 key risks that expats face: currency risk, geopolitical risk, sovereignty risk, and legislative risk. By migrating or repatriating over a period of time, over the next 3 to 5 years, his assets to Australia, there are tax benefits where you can slip through and get money into Australia and start accumulating money in Australia in a tax-friendly, sort of manner. But also to, as you said, there is no tax incentive or tax benefit to having an ISA account as a non-resident of the UK and tax resident of Australia. So what it does do is it magnifies his, sensitivities to currency.
Mm-hmm.
If you think about it, obviously an ISA account sitting in British pounds. So to me, unless he has an intention to return to the UK at some point in time down the track as a retirement or something like that, and it sort of runs into the other questions as well too. What should you do with all these other different scenarios? It depends on the numbers, whether he's going to get enough value back from, starting a SIP or selling the
Yep.
home and that sort of stuff, what happens over the next couple of years? You need to almost put a stopwatch on that period and work your way backwards. You need to say, okay,
Yep.
looking at the UK home, what's the UK market doing right now? What do I think it's going to do in the next 3 to 5 years? Am I better off selling now, taking the money off the table because UK property is going to fall over the next 3 to 5 years and rent? That's one example. I think in respect to holding UK property as an Australian tax resident, as you say, it's taxed, like any investment property, even back in Australia.
Yeah.
So once again, magnifying exposure to pounds though. Certainly on the UK final salary pension, two options there. Option number one, you leave it there. You can certainly draw the 25% lump sum out, but don't forget it comes back to what you want to achieve out of that account. There is the RAPS route, the recognised offshore pension scheme route, where you can actually move your UK pension to Australia and roll it into super. That will depend on a number of things, including contribution limits and the size of that UK pension. But also, too, once again, it comes back to my original question. Does he have an intention to return to the UK at some point and live there? Some of our clients will have a super fund in Australia and a UK pension in the other, and they'll draw on each depending on which jurisdiction at a particular point of time. So, I think if he's done with the UK, done with that lovely weather, in inverted commas, and it's home for good, back in Australia for good, then, you can get the UK pension, especially that 25% lump sum that you can draw out initially. The ATO says you have 6 months to repatriate foreign pension proceeds into Australia tax-free. After that period of time, it's game on.
Absolutely. And the UK is probably one of the only systems in terms of the pensions over there that the ATO will actually acknowledge as a foreign super fund. So there's a window of opportunity there, but with you coming back and trying to get settled, buy a new home, all those sort of things, that 6 months will go like that. So you do need to obviously seek advice well before you come back. I would say at least a year or two, probably minimum, probably 18 months before you're actually going to repatriate physically, because it gives you enough time to work across 2 financial years to get your ducks in a row. Great question. Hopefully we've answered. If not, reach out. Brian Keogh, does the US exit tax kick in from your arrival on a visa, or is it only on the green card years, please? Question mark. Great question. So
Good question.
for our listeners that aren't dialed into the US and how awful the IRS is, over in the US, they do have this exit tax, and it's what's called triggering the Heart Act. And they brought in a little while ago to really capture, I guess, the very wealthy I suppose, citizens, permanent residents of the US that wanted to leave the US, take their wealth over and away. I believe they actually might have brought it in when one of the co-founders of Facebook was trying to leave because they could see the writing was on the wall. Was it Google? There you go.
Google guy going to Singapore. Yeah.
There you go. So I think they try to close this loophole out because they thought if it's going to start happening now, and they were thinking in the future of how much tax revenue they could raise from this Heart Act, that's why they legislated. It can be nasty. Going back to his Brian's question, does the US exit tax kick in from your arrival on a visa, or is it only the green card years? So if you're over there and you're on an E3, an L1, H1B, whatever the visa, if it's rather flexible, it doesn't start when you're on that visa. It only starts from day one that you were given your green card. That's when the clock starts for those first 8 calendar years. So it's in the 8 calendar years. It's not 8 full calendar years. You get it on the 31st of December. That counts as year 1, which is remarkable. If you've held that green card or US citizenship, so normally you'll have green card first, in 8 full calendar years, then you go into another flow or subset of tests, the net worth test, the average tax liability test, and then lastly, the certification test for US compliance. Net worth test hasn't actually changed for a very long time. If your worldwide assets is over 2 million, so your net worth is over 2 million USD, then you'll flow into potentially becoming a covered expatriate, which will trigger the exit tax. The next one is average tax liability. This one is indexing each year. Right now, I believe it's about 160, 170,000. So if you're paying that kind of tax each year out of the last 5 years to the IRS, you are a high income earner. And that means, if you're paying that kind of tax, you'll know. But depending on sort of how you're paying your tax, if you're remunerated through a base wage, a bonus, and then you're getting maybe shares, RSUs, other things dumped on you each year, and they're vesting and taxes coming out of that, you can quickly rack up that tax. And then the last one is the certification test. Being able to certify on Form A854 that you are up to date with all your relevant IRS tax lodgements, your FBARs, your state returns, everything. If you are, that's fine, But if you trigger one of those tests or fall over on one of those tests, you will become a covered expatriate. Very important to know that you do get an exemption on the capital gains. And the exit tax is essentially doing a deemed disposition or deemed disposal of your worldwide assets as of that date that you live in the US. And then if you've held a share portfolio for years, capital gains will technically be realized on paper. If you have a 401k that you've accumulated for a bunch of years, it's also a deemed distribution from that 401k. So all that would be taxable. Penalty tax doesn't work into that calculation for just the exit tax, but naturally it would. If you've got assets back in Australia, such as a superannuation fund, if they're treating it as a type of trust, another deemed distribution or income. If you own property overseas, such as a former main residence, which is now an investment property in the eyes of the IRS, yes, you're selling that asset as well. So you can see very quickly these capital gains, if you held a lot of assets for a very long time, rack up very quickly. And the exemption capital gain, it used to be 720,000. It's now ratcheted up. I believe it's just over 800,000 now. That's the capital gain exemption. But yeah, depending on your assets, you can definitely pay accidental exit tax. Feel like I've answered that quite concisely. No. What have I missed?
No, you've hit the nail on the head. I think the only extra thing I'd add is it also includes property in Australia. And that's where I see a lot of folks where the rapid increase in Australian property values, it's become easier now to trigger the exit tax, based on property and super. Sometimes that's all it takes to get you over the 2 mil mark.
Yeah, that's right. A lot of you're just spot on there. I've got quite a lot of clients that have owned in Sydney or Melbourne from just the late 90s or early 2000s, and now it's just being rented out as an investment property, and obviously they've benefited from the capital gains, and now those assets, which they haven't lived in for 15, 20 years, are worth a lot. So capital gains are quite extensive. They can't sell them whilst they're a non-resident. Thank the government for that. The main residence exemption gone. So yes, you need to be careful, but when you're just on a simple visa like an E3 visa or an L1 visa, the clock doesn't start for that exit tax calculation, not until you get on a green card or you pick up a US passport.
Spot on, mate. I think we'll just do one last question, and then we'll wrap it up there. So pulling Australian retirement funds out to US bank account. I sort of want to cover this because it sort of ties in with Brian's last question. Danger, alert. The reason being is, this is Craig's question. He wants to pull his Australian super fund and put it into US bank account. The issue with that is the IRS does not treat Australian super as a foreign pension. It treats it as a foreign trust, which means income gains is taxable in the US. If you were to pull all those funds out and put it into US bank account, there is the situation where technically they could charge you on that balance that you take into the US as income. And I remember a case years and years ago when we were talking to a lady who had an SMSF in the US, which is a big no-no for expats in general, but especially in the US. And she thought she was doing the right thing, and she drew down a $900,000 SMSF portfolio. And guess what? The IRS turned around to her and said, guess what? You've just earned $900,000 for the year. You're paying tax on that balance. So in answer to Craig's question, you need to be careful, when pulling money out of super into the US. Because you do need to speak to James and his team who specialise in the US side, because that can be a very expensive exercise.
Absolutely, mate. Well, mate, we'll wrap it up there. What a great episode, some great Q&A. God, there's more questions. We didn't really get to them today, but don't worry, we will come back round to them. Plenty more episodes coming out. Quick shout out to the masterclass coming up, Brett.
Yep, mate, we've launched that, so it's on the socials and emails and everywhere else in the world. So Riyadh, Dubai and Abu Dhabi. There'll be the team of 4 strong, yourself, myself, Jeremy on the mortgage side, and Ben, our tax guy. So go to our events page. It's on our website, atlaswealth.com. Under events, you'll see them all there. Very easy to register. I promise you, and it's an easy promise to give, you will get so much value out of this, because especially for folks in Saudi. This is the first time that an Australian financial planning firm has actually done this in Saudi. So you've never heard this stuff before unless you've been on the podcast when you've heard some of it. But in terms of that face-to-face interaction, even in Dubai, Ben's actually never been to Dubai, so I'm looking forward, or Abu Dhabi for that matter, so I'm looking forward to showing him around. You and Jeremy are all hats here. But mate, it's going to be worth people's time. We'll give you a bit of grub, give you a drink, but also to, I think, the amount of information you'll get in a very condensed amount of time will be far greater than anything you read online or meet other people with.
Absolutely, mate. What a please get there. Obviously the drinks will be light in Saudi because where we are.
Yeah,
but
sodas.
Let's try a couple of lemonades. But in the meantime, guys, thanks for tuning in for another episode, and we'll see you on the next episode. Thanks
guys. Take care.